Good evening, everyone. Time for another silver update. Now, this is the daily chart of silver provided by netdania.com. You can click on the link below. And you can see here that with the trend line that we've got drawn in here, that we're now almost below $20 for the trend line itself. And that means that for this trend to be broken, it's actually just going to take a rally above $20. That's really incredible when you think about the fact that it's taken 9 months or so for the price to come down enough for that to be the case. Now, I'm still expecting a big drop-off correction and bounce back up. Probably the bounce back up will take out this downtrend line, and then it will be a rally from there. But it's definitely steadily weakening. If we go to the 1 minute chart, we can see we'll put in the volume. And we've had a couple of periods here where they came in with pretty big volume, rallied it. Actually, we'll clear it off and do the volume again. We'll do the 10 minutes. So you can see here the two spots where we had pretty big volume. There's one here, one here. I actually think we go a little bit further back. And when it sold off and went down below that 19 price, some pretty big buyers came in. And so it appears that there is some other forces at play here who are interested in buying the paper. I can't imagine why anyone would be interested in buying the paper. Maybe it's the Chinese. But you can see here these two spikes, this volume spike here, which caught it when it got 1890 or so, and it rallied all the way up, about $1 rally. This one not quite as much. Another one, little spike here, but now it's kind of, the price is kind of falling off. So we may get that test next week. We may get the test fairly soon, but I expect a snapback rally after that. Now, I wanted to share with you something that I had come across. I was actually going through, well, this is just kind of like a generic document, but I was going through an annual pension summary notification that I received on my pension. That is, the company I work for has a traditional ERISA pension, which means that it's federally regulated. And it was really shocking to me to come across a law that I had no idea, I'd never even heard of before. It wasn't until because I read through that stuff, anything like this, with a fine-tooth comb, and I came across a paragraph that referred to this law that I had never heard of. And the name of this law is MAP 21. And it actually said in my pension document, it said, due to MAP 21, the calculation of the required payments by the company to the pension plan will be significantly reduced, as they have changed it over to a 25-year smoothing of interest rates. And I found that to be very shocking. So I did a little bit of research, and I did find an article on this. And this is a perfect example of the sleight of hand that these politicians do. This is from July 6th of 2012. The 2-year Omnibus Highway Transportation Bill, H.R. 4348, passed Congress on June 29th, 2012, and signed into law by President Barack Obama on July 6th, includes long-sought funding relief for employer-provided defined benefit pension plans. The measure, known as the Moving Ahead for Progress in the 21st Century, MAP 21, wow, the names they come up with, also raises the premiums that plans pay to the Federal Pension Benefit Guaranty Corporation. Under the Employee Retirement Income Security Act of 1974 and the Pension Protection Act of 2006, defined benefit plans are subject to minimum funding rules that require employers to make contributions to the plan in order to fund the plan's benefits. When interest rates are low, pension plan liabilities are estimated to be higher, and employers are required to contribute more money to meet their minimum funding obligations. Under the new law, employers can put less money into their pension plans by using calculations that allow them to value liabilities using higher interest rates than the prevailing low rates. For instance, under the law's so-called smoothing or rate stabilization provision, the interest rates used for estimation of pension liabilities and determination of employer contributions, which statutorily have been based on the 2-year average of interest rates, will be adjusted so that they are based on an average interest rate for a 25-year preceding period of the current year. For that 25-year period, the alternative discount rate is shown below. So, do you see what they did? What they did was they decided that although we're holding interest rates at 0, if we do the calculations based on those 0 rates that we have and require employers to add to their pensions enough to actually pay the pensions that they've promised, and because the interest rates are so low, they have to pretty much fully fund those pensions because they can't expect to make any interest on the money that they invest because interest rates are nearly 0. So rather than fixing the problem, which is too low of interest rates, raising the interest rates, no, they can't do that because that's part of their rigged game. So what they did was they changed the period of time they used to calculate the average interest rate from 2 years to 25 years. So, for example, we know that 25 years ago was 1989. We know that we had interest rates of as high as 7% in the 90s and mid-90s. So they're going to take an average of all those and assume that they can get that, even though they can't. So there's a perfect example of something that the only reason why I caught that little scam is because it actually personally affects me. It affects my pension because it allows my company to contribute less money to my pension because it can assume an interest rate that it can't get in the real market. Unbelievable. And of course, the motivation behind this was twofold. One was they could push more money into their Pension Benefit Guaranty Corporation, which is basically bankrupt. But also, the stated reason was that they can increase tax revenues because they would be able to tax more of what the employers pay rather than put into the pensions. So, unbelievable. Now, let's look at this article that's on Zero Hedge. This is about the Postal Service. Same sort of issue. The U.S. Postal Service loses $1.9 billion. Now, that's in a quarter. So if you think about that, that means that the post office is bleeding $8 billion a year every day that it stays open. And it says they need $10 billion in bailouts or pensions get it. Revenues are up modestly for the U.S. Postal Service as first-class mail volumes continue to tumble extremely, but package volumes are rising. However, USPS records a $1.9 billion loss in the last quarter, despite efforts to streamline efficiency and cut costs. The rise in package volumes appears related to a Sunday delivery deal with Amazon.com, who, quote, found a great fit with the USPS capability and desire. However, USPS says it needs $10 billion for deferred investments, and it warns if it does not get its bailout. And it goes on. So they're talking about cutting the benefits to the postal workers unless they get this bailout money. Now, people have pointed out that it's unfair because the Congress, supposedly the Republican Congress, required that the post office fully fund their pensions, and that's the only reason why they're in a crisis. Well, that's like arguing that, you know, it's not fair because we promised to tell the truth while everybody gets to lie under oath. I mean, that's just absolutely ridiculous. This is the only one that I know of where they're actually required to fully fund their pensions, and it's obvious that they can't do it. So the answer to that is to not promise such lavish pensions, to cut back on the pensions that they promise, rather than do that, though, of course, because this is obviously going to be a liberal piggy bank for the unions to, this is going to be a way for the left and Obama and all these others to give money to their supporters. So obviously they're going to take taxpayer money and use that taxpayer money, billions of dollars, and give it to their friends in the post office running this bankrupt business that would be out of business by tomorrow if it were in the free market. But of course we know that it's not in the free market. It wouldn't even exist anymore. So that's just one example of the type of thing that's going on with the pensions. Now, we know that eventually all the pensions are going to go bust, because the majority of the pensions, we saw this in Detroit, we're seeing it in Chicago, we're seeing it in California, we're seeing it around the country. We know that these pension managers are assuming a return of as high as 8%. I think the average is around 7 or 8%. They're assuming this type of return to be able to pay out the promises that they've made. And they have to return that 8%, 7 or 8%. They have to return that year after year after year after year. And this is an environment where interest rates are near zero. So as you can see in my plan, what they did was, rather than ponying up the money that they need to fully fund the pensions, they just changed the rules on how they assumed the interest rate would be. And now, of course, that is for an ERISA pension, which is federally regulated, so they actually had to change the rules because there actually are rules. But for these other pension plans that aren't under federal regulations, that are just run by these private companies, or even some hybrid like the post office, they're just going to assume that they're going to make 6, 7, 8% year after year after year. Notice there's no assumption for a loss in there. And I covered before how extravagant some of the investments they're getting into. So you can imagine how difficult it would be to have a conservative investment where you're not being very risky with the money that you're investing, and still have that conservative investment pay 6, 7, 8% year after year after year after year. So we know that it's impossible. We know that there's no way that any of these pensions can pay off, and it seems like they're just trying to kick the can down the road to where they're just going to default on everything all at the same time, and maybe that's why they're so busy collecting bullets and getting ready for martial law. So we know that silver and gold are going to be the only investment that stands when this gigantic house of cards comes crumbling down, and it is going to come crumbling down. I think that, again, with silver, we appear to be testing that low point where they're going to give it a run to see. I think they really want to know how far below this line they can take it before something happens. And I'm not really sure what that something is going to be when they take it below this line. But I've seen this formation here that we're forming up. I've seen this formation a lot in markets, stocks mainly, but I've also seen it in commodities. And when you see this sort of formation, this is almost like a head and shoulders. The market definitely wants to get down in here and test and find out at least what's going to happen, and perhaps even run down to this low, which is all the way down at 15. And if we get that, we're going to have a tremendous buying opportunity. We may get a break below that as early as next week, and we'll talk to you next time.